Rosa, thanks very much for doing this. I'm very interested in the subject of international law. I realize it's absolutely central to our project about the future of the global financial system. So I'd like to start maybe with just a few very basic questions, just so we're all on the same page, and ask you really to explain what international law is, as opposed, let's say, to legal authorities cooperating across borders. What is the essence of international law itself?
Yes, international law is a field which comprises actually two subfields. One is public international law and the other is private international law. Public international law deals with the rules that govern the relations between states. And when it comes to public international law from an economic perspective, those are the economic relations between states. But obviously we also have political relations, defense relations. And in addition to that, public international law also refers to the law of the organizations that deal with such relations. For instance, at the political level is the United Nations, and at the economic level, depending on whether it is trade, whether it is investment, whether it is money and finance, we have different organizations. So for instance, WTO, the World Trade Organization, is the international organization that deals with trade. The IMF was set up to deal with the monetary leg of economic relations. And the World Bank was set up as the International Bank for Reconstruction and Development to deal in part with investment and in part with development. So that is public international law. In addition to public international law also comprises private international law. And private international law is also referred to as conflict of laws. And it refers more to private individuals and private transactions. So if there is a conflict between two companies or two individuals, which jurisdiction or which laws apply? And if that is going to go to a court of justice, which court of justice would have the authority to listen to that case? So in a nutshell, public international law and private international law are the two sides of international law. And it reflects the broader divide in law generally, where we have public law, like administrative law, constitutional law, and where we have private law, which has to do typically with commercial transactions, family relations, and other issues.
So I'm going to ask you for a few examples outside of the monetary and regulatory arena, which we'll come to, just to make this very vivid. Can you give me one good example of international public law, one field where it operates quite effectively?
Yes. Let me give you two examples, one economic and one non-economic.
Okay.
The non-economic, the law of the sea, which has been developed over a large period of time, establishing what are the territorial waters of different jurisdictions. On the economic level, which is the one that is most relevant to the project that you're doing, let me give you the example of international trade law, which is a highly developed branch of public international economic law, which has to do with the trade relations between states. And WTO, which initially, when the Bretton Woods Conference took place in 1944, the delegates dealt with the future of the international economic system, and they tried to establish the basis for peace, like Keynes had said, the economic foundations of peace. And they thought that there should be three legs in those international economic relations: trade, money, and investment. Because of lack of political agreement in the US Congress, the charter for the so-called International Trade Organization failed to be ratified. It was called the Havana Charter because it had been sanctioned in Havana. And then what happened next is that instead of having a proper international trade organization, for a long period of time we had what is called the GATT, General Agreement on Trades, Tariffs and Trade. And in 1995, the GATT became a formal international organization, which is WTO, the World Trade Organization. following the agreement in Marrakech, and also incorporated not only trading goods but trading services, which have been part of the GATS, the General Agreement of Trading Services, since the Uruguay round of trade negotiations in 1986. So why is WTO such an important example of understanding why public international law works? Because it is a rule-based system. Instead of being a discretionary system, it is a rules-based system, and it has established and accepted dispute settlement system. Is this important? It is very important because it provides a forum where the small country can take another small country, where a small country can take a large country, and where a large country can take another large country or a small country. It provides an effective forum recognized by all parties with legitimacy and transparency for sorting out conflicts or disputes that have to do with trade issues.
So would it be fair to say that if you looked at the WTO, the essence of the way that the law works is, first of all, everybody has signed a treaty. That's to join the WTO. And secondly, in signing the treaty, they are bound by the rules. And if there is a dispute about the rules, it has its own adjudication system. It has its own court. Is that the essence of it?
That's the essence of it, indeed. And also the added benefit of that is publicity. Everybody knows what the rules are, and everybody knows that the judgment will have to be respected because it is part, talking a little bit colloquially, of the rules of the game when it comes to international trade. So yes, it has actually been a great advancement, and if you look back at the global financial crisis, the resilience of the international trading system is quite remarkable. If one looks back to the Great Depression and the interwar period, one of the things that is quite remarkable is how countries turn to protectionist trade practices. So in a way, the systems of WTO has prevented a resort to protectionism on countries which have been going through a great deal of, if you wish, suffering, strain, and tension during the crisis.
So one more question on the WTO, just as the case study. How do you think about the ability of international law to override national law? When the countries sign that treaty and they bound themselves to the provisions, and there's a court, and let's say the court rules against someone, is this the highest kind of law? Does this law have precedence over domestic laws?
That is a very relevant question and a very important one. Indeed, whenever countries sign an international treaty, whether it is to become members of WTO or become part of another international organization, it implies a concession of sovereignty, a surrender of sovereignty. So in some areas, that surrender has been easier than in others. As we move into the monetary and financial arena, there has been a great resistance to give up sovereignty when it comes to money and financial markets. And that's why, up to this day, in the field of money and finance, we rely still upon national regimes based upon loose coordination and, as we will speak later today, soft law. While the regime in trade is formally based with a system of rules and a dispute settlement system, and while the regime in investment, which is different because in investment is more a bilateral regime and much more based on arbitration and you're the tutelage of the International Center for the Settlement of Investment Disputes, which is under the umbrella of the World Bank Group. In money and finance, we do not have a multilateral formal regime. We have a collection of international organizations like the BIS, the IMF, which we can talk about that later, but most of the rules still, the European dimension is different. It provides at the regional level an increasingly integrated solution, but internationally, for the most part, we still rely upon national rules, national policies, and then different degrees of cooperation and coordination, and whatever we have internationally is mostly of the level of what we in law call soft law.
Okay, so let's go into that now. Let's start with the monetary system. You know, the world of the central banks, exchange rates, coordination or lack of in monetary policy. How do you think about the development, or how do you think about the status of international law today as it applies to that complex of issues?
That is an ongoing debate, the extent to which central banks, which have, as I would say, inhabited in a world of policy, should be increasingly subject to a more law-based regime. It's not that they operate within a framework of law, but when they conduct monetary policy or exchange rate policy, the legal framework which applies is very loose and typically not very detailed. There are, however, increasing effects about monetary policies, redistributive effects, for instance, the quantitative easing have, or extraterritorial effects for which we do not have an international legal framework. So at the level of monetary relations, the one institution which we established going back to the Bretton Woods Conference in 1944 was the International Monetary Fund. The International Monetary Fund was established to enhance monetary cooperation upon the member states which became signatories of the IMF Articles of Agreement. And that was a simple rule, the par value regime, which lasted perhaps in an imperfect form until the famous closing of the gold window by President Nixon and the formal abandonment of the fixed exchange rate system and a worldwide move to floating exchange rates with the Second Amendment to the Articles of Agreement, which was in 1978. So since then, international monetary law relies upon the limited rules which the IMF provides. And those limited rules are basically focused on surveillance. So some rules of the game were established by the IMF and by the IMF Articles of Agreement, and countries are expected to comply with those rules, particularly what is called Article 4 and Article 8, and the IMF monitors whether or not the country does well. Outside the IMF Articles of Agreement, there is really no formal law that governs international relations when it comes to monetary issues. No formal rules on monetary policy, no formal rules on exchange rate policy, no formal rules on currency intervention, no formal rules whether a currency is overvalued or undervalued and undermines the competitive position of other countries. So the truth of the matter is that though we have Article 15 of GATT and Article 4 of the IMF Articles of Agreement, for the most part, international monetary law is very limited when it comes to the functioning of the international monetary system. I have to say that particularly the IMF likes to distinguish between the international monetary system and the international financial system. The international monetary system has to do most with money, balance of payments, reserve, exchange rates. And the international financial system is a much broader phenomenon, and it encompasses global institutions, it encompasses private markets, and is certainly not a homogeneous global financial market. So it's a set of institutions and markets. I think the division between the monetary system and the financial system, and in a way the goal of monetary stability and financial stability, at the level of the central banks, there has been, in the context of the financial crisis, a recognition that monetary stability alone cannot be the mandate of central banks. The U.S. Federal Reserve System does have several goals in its charter, in its Federal Reserve Act, but other central banks do not. So why do I say this from the perspective of monetary law? Because when one talks about international monetary law, one cannot really say that it is a complete separate category from international financial law. In the same way as at the national level, the monetary system and the financial system do not have a perfect division. At the international level, we do not have a perfect division between the international monetary system and the international financial system, even if sometimes the IMF, there was a document in 2010 in which they still like to stick to that division. So where does that leave me? That leaves me that the efforts that are done with regard to formalizing the law that governs international relations in money should not be exclusively concerned on money, should be money and finance, should be the international monetary and financial system. So though in the very interesting list of questions that you gave me. There were questions related to the international monetary system and international monetary law, and questions related to the international financial system and international financial law. There is a degree of intersection between the two, which I would like to point out. Why? Because in any design of a set of rules, we need to know what reality we're dealing with. And the reality that we're dealing with is much broader than simply talking about, which obviously in itself is an important category, money, reserves, exchange rates. It has to do with the broader financial markets and institutions upon which many of those variables actually take place.
Fair enough. Let me just, I'm going to go to the financial arena, recognizing the connection, but just for the sake of trying to explain this, let's talk about the regulatory system. There's been a massive amount of regulatory development over the last several years since the financial crisis. We have the Basel agreements on reserve levels. We have lots of discussions that are attempting to harmonize certain provisions of Dodd-Frank or their counterparts abroad. But in the same way that you address the monetary system, put us on the map. How much international law actually exists now when it comes to financial regulation?
When it comes to financial regulation, most of the international law that we have is of a soft law nature. Let me clarify that the difference, the substantial difference between hard law and soft law has to do with enforcement. While hard law is directly enforceable according to the traditional mechanisms of enforcement, which are not in national jurisdictions, soft law, whether it is international or national, is not enforceable through those traditional means. Is rather observed, and I point the word observance instead of enforcement, through other means, name and shame, peer pressure, denial of market access to others. So most of the rules that we have at the international level with regard to the international financial system are soft law rules. And who issues those rules? We have a large number of what is called international standard setters. Those international standard setters that issue standards or soft law rules, or sometimes formal international organizations. For instance, the IMF also issues soft law rules like codes of conduct. Those are soft law rules. They are not the hard law of the Articles of Agreement or the decisions of the Executive Board. But most of the international soft law that governs financial markets comes or emanates from these international standard setters, of which the most important one, because it really fills a vacuum in banking, which is the Basel Committee. The Basel Committee on Banking Supervision came into existence precisely to assess the responsibilities with regard to home and host country supervision, and eventually became a de facto international regulator by issuing the rules on capital starting in 1988, and then subsequently a large number of rules on a very large number of issues. Together with the Basel Committee, which has to do most with the working of international banks, we have IOSCO, the International Organization of Securities Commissions, we have the International Association of Insurance Supervisors, and then we have a mushrooming of other international standard setters. In 1999, in an effort to try to give a little bit of coherent approach to this process that was becoming like the idea of mushroom is quite expressive in that it reflects how it was growing without really any clear direction, the Financial Stability Forum was set up. The Financial Stability Forum, like all the other international standard setters, they are not formal international organizations, so they're typically staffed by technocrats and they don't have the formal legitimacy or mandate that an international organization has. It was set up in 1999, and then in 2009, at the instance of the Group of 20, it became the Financial Stability Board. So we have these international standard setters which issue rules which I will refer to them as top-down rules. The rules that are established by a committee. The one that is most quoted in our field is the Basel Committee because of the importance of capital regulation. And those rules, they need to be incorporated into national legislation or EU directives, and then they are complied by the financial institutions themselves. That's why I say top-down. a top-down phenomenon with a two-tier approach. The committee, then it has to go through national law or regional law, and then it affects the institutions. We also have, and it's very important to recognize it, a growing phenomenon, which is also part of international financial soft law, in what I would refer to as bottom-up approach. Sometimes an exercise in self-regulation, but sometimes also an exercise in the work of private associations. For instance, the Eastern Master Agreement is a classic example of a rule with regard to swaps and derivatives that these days is accepted by most market participants, where they don't deviate from the standard. And if they do, they have to explain why, explain why you do that. And so this is what international financial soft law is the main component of international law in finance. Does that mean that soft law is not law? No, soft law is law. It's important to take that in mind. Indeed, if one looks back to the origin of law, a lot of the law that we have these days emerges in formal law, and eventually, like the lex mercatori in the Middle Ages, eventually through a process of formalization or through a process of customary practices or a process of accepting it as general principles of international law, it became part of the accepted body or corpus of international law. So that is one part of international financial law. And it is very important because the rules that we have, for instance, on capital or cross-border emanate from these international standard setters, which are not formal international organizations like WTO or the IMF can be. We also have what in law we refer to as multi-layer governance, which is that recognizing that the governance of financial markets has different dimensions, there is an acceptance that those different layers of governance imply different functions, and in a way resorting to the principle of subsidiarity, some of those functions are done better at the national level, some of them are done better at the regional level or European level, and some are done better at the international level. And perhaps in the debate about why do we need international law in money and finance, one needs to look back at these functions. What are the functions that really do not operate effectively if we simply rely on a national platform? And clearly, cross-border resolution of crisis is one of those. Part of the premise of my argumentation today is that financial markets and institutions have grown international or have become much more global in recent years, but their law, their policies remain for the most part nationally based, exception being made of Europe, which we can talk about later. Where does that leave us? That leaves us that certain decisions, for instance, the cross-border resolution of financial crisis or cross-border resolution of sovereign debt crisis, are dealt with still using national law instruments. And obviously that's not an effective way of dealing with disputes. An effective way of dealing with disputes is for the two parties to agree ex ante which rules are going to apply, and those rules, they need to be independent from their national regimes. When you do not have such a rules, then sometimes, which is what happens these days in international financial markets, we have situations of regulatory arbitrage, sometimes run to the bottom, increasing transaction cost. So going back to your question, international law in finance is mostly of a soft law nature. I envisage that with the passage of time there will be a degree of formalization, moving from soft law into hard law, in the same way as in other areas like trade, which we mentioned earlier, we have now established system. What are the advantages of international law? And why do we think that such a system of rules, which is not nationally based but rather has an international dimension, and therefore a giving up of sovereignty in those areas where countries choose to pool that sovereignty for a higher good? It has formality, it has legitimacy, it has national representation because countries have to sign up to agreements and therefore have to agree to the terms, substantive terms of what it is that is being pooled in terms of sovereign powers. It has accountability and it has transparency. Some of the issues that sometimes also at the national level when we talk about agencies is always the concern about, too much independence and too little accountability, too much technocracy, too little democracy. If one uses that analogy, and it's not a perfect analogy, at the international level, what formal international law provides is that degree of legitimacy, accountability, and transparency that is not always present. It is sometimes present, but is not always present when one talks about soft law.
So, if I were to try to find a very strong thread through what you're saying, this is what I hear, and tell me whether I have it right. There actually is a huge amount of activity in the both monetary and financial arena when it comes to discussions about norms. That happens at many, many different levels. But the key issue that is missing, if you compared it, let's say, to the trading arena, is the hard law aspect. That is the ability to enforce. That there's no lack of understanding of kind of, what's going on and a huge amount at different levels of discussion. But when it comes to enforcement, you're really talking about the surrender of sovereignty. And that is one of the really major fault lines that exists. The disparity, let's say, between the globalization of the markets, the spillover of economic activity, financial activity across all borders, and the inability, or let's say the lack of law that basically not only sets the rules and the norms, but is able to enforce it with a threat of real punishment. That's what's missing compared to trade. Am I right?
Yes, indeed. And in one of the writings that I did together with two professors, Professor John Jackson of Georgetown in the US and Professor Thomas Cotier of the World Trade Institute in Bern, we call that the black hole of international law when it comes to monetary and financial issues. And we concluded that that black hole is in part due to the fact that there was a perception before the crisis in particular that markets, financial markets, were best left to their own devices, and that therefore, why would one want to intervene when they're already functioning sufficiently well without any formal legal framework? The second strand of argument is that things have worked pretty well by having different national laws and different national regimes. Why would we want to give up sovereignty in an area which is, they always say, the pocket is close to the heart, in an area that touches upon the economic interest of the states? So those two arguments, one, that financial markets are best left to their own devices, two, national law is sufficient. There is actually quite a great deal of national law. I mean, if one looks in the US at Dodd-Frank is a humongous piece of legislation. And the previous pieces of legislation, Sarbanes-Oxley, the Financial Modernization Act, and then going back to the 1930s with the New Deal legislation, and then all the regulations that later on were implemented by SEC and the Fed, the corpus of national financial law is humongous. It's really, really very, very, very large, extremely, extremely substantial. To a lesser extent, in Europe, we are also developing I call it almost a flurry of legislative and regulatory responses to different aspects of the financial crisis. And again, the corpus of financial law in Europe is growing exponentially. So it is not lack of either national or regional initiatives. It is a reliance on those initiatives which sometimes actually are not coordinated. So again, institutions, and the example of Lehman Brothers has always been cited as an example of how this dichotomy between international financial institution and national law became a disaster because we did not have rules to deal with the insolvency of an institution that had branches, subsidiaries, and operations in many jurisdictions. And since then, that has been perhaps the most clear example of how the system didn't work. But it's not the only example, and perhaps unless we solve this situation now, we may come up next crisis, we're always fighting the last war. So we do not know where the next crisis will arise. But certainly, to identify the next crisis, one needs to look at the fault lines in the system. And you have looked at different macroeconomic causes, imbalances between the US and China and others, loose monetary policy, blah, blah, blah. A very important fault line that still remains is this lack, this black hole of formal rules which are accepted by all parties. Have there been progress? Has there been progress? There has been some limited progress in some areas, mostly again via soft law. For instance, with regard to the cross-border resolution of international financial crisis, there have been the key attributes of the Financial Stability Board, which established at the international level a series of measures, which these days actually they find their way into domestic legislation, often because the IMF, it is going to require, if it's going to grant financial assistance to a country, will require as part of the conditionality a number of reforms, and these days it is likely to include that if the country has not got sufficient resolution tools to deal with failing institutions, they will have to enact this law. But still, the rules that exist, and they're of a limited nature or of a soft law nature. Different again is at the European level, where at the regional level we are actually getting a proper system of hard law rules that will deal with this cross-border resolution of failing or troubled financial institutions. But at the international level, the fault line remains. And as long as institutions remain and want to remain global, and I, for one, am in favor of globalization, as long as institutions do not want to retrench back to being renationalized or deglobalized, we need to adjust the law. In the same way, the law establishes norms for personal and collective behavior, boundaries. And at the international level, it's the same. So we need the law. People sometimes would think of the law as intrusive, of centralizing, but no, the law establishes the rules of the game. When it comes to financial markets, at the national level, it is clear in Dodd-Frank that the rules of the game has changed. This fault line at the international level, I remain very concerned that we haven't sorted it out yet, and we may keep on doing business as usual. But the fault line, like in an earthquake, remains, and it might be that in the next crisis, and who knows where it will come from, it will be a side effect of one of these fault lines.
So I'm going to ask you about if you could wave a wand, if you had, there were three things that you would like to see, let's say, hard international law developed. One of them, obviously, is this resolution of failed institutions, because you've talked about that, so-called resolution authority. But beyond that, what two high priorities would you cite in terms of things that are really urgent? You know, rules of the game, together with enforcement, that would really strengthen the global financial system, you know, broadly defined. Are there two other areas that you think are particularly important?
Yes. If one looks at the functions at the national level when it comes to financial markets, one can identify three functions. One is regulation, the other is supervision, monitoring, and the other is crisis management. When it comes to crisis management, you have lender of last resort, you have deposit insurance, you have resolution, you have insolvency, and then we have all the implicit policies of too big to fail, implicit protection of the payment system or depositors or the banks themselves. At the international level, if one moves this analogy, we have also the function of rule making, and we have, as I said, a number of rules that come from a large number of either institutions that issue top-down standards or market associations or professional associations that issue bottom-up standards. But if a country does not comply with those rules, we do not have a forum where we can go and complain. So if country X or country B uses capital rules in a way that makes their banks enjoy a competitive advantage over other institutions that institutions in other countries that are complying with the rules, there is no forum where you go, like you have, for instance, in WTO, to complain. So that's a very important function. I like to think about functions when one talks about the international financial system, the law that will apply to the international financial system. Sometimes people talk about the World Financial Organization. It becomes almost like a Leviathan. But one needs to look at what are the functions that we need. So with regard to regulation, we do not have a forum for settling disputes. And I think that is very much needed. When it comes to crisis management, we all know what crisis management at the national level is: injection of liquidity, and then solvency support, and then working with the institution to restructure assets and liabilities, and so on and so forth. At the international level, this has two dimensions. One is the private dimension, and the other is the sovereign dimension. At the level of the private dimension is what we have talked about, having a resolution authority and having a system of rules. So we will talk about the two things, an authority plus rules. Rules that have to deal with the cross-border insolvency or cross-border resolution of financial institutions. But also when it comes to the problems of sovereign debt restructuring, and the cases of Argentina or Greece shows how much still uncertainty there is in how to deal with those issues. We need, in my opinion, a more formal structure. What else do we need? I think that the understanding of systemic risk, which is something where economists have done a great deal of work in recent years, is something where we still have a long way to go. And one of the dimensions of systemic risk that can never be overlooked is that, like a tsunami, it does not respect any boundaries, any geographic boundaries. So episodes of systemic risk are, by definition, systemic, and therefore the contagion can be regional, can be international. You do not know typically ex ante of how far the externality of that systemic risk is. And how are we doing with that? Well, we have established councils of financial stability, like the Financial Stability Oversight Council in the US, or the European Systemic Risk Board, or in England, the Financial Policy Committee as a part of the Bank of England. I am quite concerned about the need to coordinate the work of these different councils of financial stability, because the advent of macroprudential supervision, yes, is to look at the forest as opposed to looking at the trees, but the forest in which this institution lives is not confined again to the jurisdictional domain of the country where that council operates. So there needs to be much greater coordination among the different councils of body or in charge of macroprudential supervision of financial stability, in order first to identify systemic risk and then contain and control it. And I think, that that requires, what role does the law play in that? Well, we will have to establish a system of rules, or under the Financial Stability Board or under the IMF, where those councils could actually come to some conclusions that then, some way or some other, through perhaps a two-tier system, could be enforceable in national jurisdictions. And the last function where I think it's important to perhaps revamp the authority of one of the existing organizations is the authority of the IMF. I, for one, think that the IMF, because of its broad memberships, 188 members, it has legitimacy, it has sufficient representation, it also has resources, and it has tools. So what tools does the IMF have? Which typically the three main functions of the IMF, which are surveillance, which is at the national level we will call that supervision, is the surveillance of how countries, exchange rate policies, macroeconomy, but increasingly also financial sector are doing. And then it has not only it has then the system of carrots and sticks with conditionality. Countries that get into trouble have to come to the IMF, and the IMF imposes a set of conditions. Those conditions, of course, are influenced by the surveillance function. The IMF cannot be cheated because it has seen through its Article 4 consultations how well or how badly a country's financial system is. And so I think one can revamp the existing institutions, and again, without getting to some sort of regulatory leviathan. I was saying before, we do not have a forum or a body where one can present disputes if one thinks the country is not complying with the soft law rules, let's say on capital. And where do you go? And I think that the IMF role as a global sheriff, and this is not a word I have taken, I think George Soros used the words of global sheriff, and perhaps some other commentators have used too. That role as a global sheriff, which is kind of enforcer of rules, is something that perhaps can be revamped. Because I go back. What does international law do? International law does two things. One is it governs the relations between states in any given area, money, trade, investment, defense, and then it also governs the international relations that we set up to deal with such relations. And so we need both the rules, but we also need the institutional framework. So sometimes one forgets about the institutional framework. We need the two of them. We need a system of rules and we need the institutions. I mean, the clear example of where that is happening is at the European level. At the European level, to a large extent in response to the crisis, we have set up a new system of rules. And if we just, for instance, focus on this aspect of resolution, we have the Bank Recovery and Resolution Directive. But we are also setting, even if it is imperfect, we are setting a single supervisory mechanism with the ECB in charge of supervising financial institutions, and we are setting up a resolution authority, which is the Single Resolution Board. If you look in a way which is interesting at the US, the history of the US as a federal country, so and then one does an analogy with the international level. You did not have in the US a federal supervision, and you did not have federal crisis management until the beginning of the 20th century. First, you established federal supervision through the Federal Reserve Act in 1913, where you also established the discount window lending, so one element of crisis management, the provision of emergency liquidity assistance, in recognition that the state measures were not sufficient and you needed a federal structure. And in the 1930s, in the context of the Great Depression, the New Deal legislation, in the context of banking, established a federal system of crisis management, the Federal Deposit Insurance Corporation, and it gave further supervisory powers to the existing agencies. In Europe now, we are kind of doing the same. We are moving from national supervision to European supervision, kind of the federal. We don't call it federal because Europe is not a federal state. It's a loose confederation of member states that have given up parts of sovereignty while they retain some others. Fiscal, defense, and others, but they have pulled a large portion of sovereignty. And we are now moving also into federalization of crisis management. So if one looks into the future, this process of federalization, which responds to the fact that in the case of Europe, the markets are no longer national, they are European, because we are part of European Monetary Union, one could make an analogy with the international level. Indeed, one of the arguments that has justified the establishment of single supervision in Europe is what is called the financial trilemma. The financial trilemma, a trilemma instead of dilemma, trilemma, which is that you cannot have the three things which are, you cannot have national financial supervision, integrated markets, and financial stability. One of them has to go. And the one that has to go at the European level is national. But the analogy can also be done at the international level. You cannot continue to have only national supervision if you want to have integrated markets, or you can say globalized markets, and you want to preserve the goal of financial stability, not simply at the national level, understanding that systemic risk has, by definition, a dimension that transcends boundaries. It is like a tsunami. It doesn't respect the jurisdictional domains that are still the ones upon which national law operates as part of the nation state. So I think you can extend the analogy, and if you look at the history of the US, the federalization, and you look at the history of Europe, it's not far-fetched to say that as long as we want to continue with integrated globalized markets, and as long as you want to continue with the preservation, if we think it is worth to have financial stability international, that at some point we will need to give up some elements of both supervision and crisis management.
So my final question is this. In terms of the evolution of international law in monetary and financial relations, what are the forces that are going to advance it? I mean, in terms of the two analogies that you made, the U.S. and Europe, if I understand it correctly, the force was pretty clear. It was the force of crisis. That is, nobody developed the laws in as a preventive measure. It was always reactive. To what degree is that the inevitable pattern here? And I would kind of like you to address it in two parts. The first is, where is the intellectual ferment? Who's actually developing? Is there a center of gravity for thinking about this and pushing it? And secondly, how should we think about the kind of push that is going to be needed in order just to deal with a few things, admittedly very big things, whether it's resolution, sovereign bankruptcy, dispute settlement? You know, these are things that sound like very, very necessary, but also very far away from just the standard setting and the discussions. So just give me a sense of where the ideas are going to come from and what's going to actually, what kind of global environment is going to be necessary to move it ahead.
Yes, it's a very good question, because, as you say, is usually after a crisis that one finds the will, the political will, to make the changes, particularly when it comes to concession of sovereignty that are required to move forward. So going back, for instance, to Bretton Woods, it was in the context of the terrible disaster that the loss of human and economic loss was triggered by the military conflict, that the countries found the political will to get together and to sign those agreements. But the window for change is fragile and is short. That's why, in a way, this phrase of Rav Emanuel, never waste a good crisis, is an important one. It is true that the window for change is related to a crisis. So what can be done when the crisis is no longer there? Because by definition, in principle, regulations should be designed in good times. It's like the biblical story of Joseph. You build up the resource in good times in order to be able to have sufficient resource when the bad times strike, which they will. But that ideal scenario doesn't always happen. So now that we have escaped, well, I don't have a magic wand to know if we have fully escaped or not, but it seems that we are out of the woods, both with regard to the global financial crisis, where most commentators would say finished 2009, and the Eurozone debt crisis, where most commentators would say it finished in its acute form in 2012 with the announcement by Mario Draghi of that outright monetary transactions. So we are not out of economic recession in Europe, we are not out of many of the economic problems associated with the crisis, but we are out of the crisis. And then the political will to do things starts to recede. So does that mean that one should remain inactive? No, because one needs intellectually to develop the basis to have something ready to be able to be approved when the next crisis strikes. So the things that we have discussed today are things that should be on the table when the next crisis strikes, because it is likely to be related to one of those three aspects that we have said. So it's important to continue the academic debate, the policy debate, to the extent that one can have that policy debate in order to develop the intellectual activity that will in future prevent or help contain the next crisis. So what centers of activity do we have? If one looks particularly at the legal framework, the interaction between law and finance, well, I'd like to say where I am is one of those centers, the Queen Mary University of London, the Centre for Commercial Law Studies, and the scholarship that me and other people undertake. And we have been also very active in working with institutions like the Bank of England. I recently organized a seminar with the Bank of England on some of these issues. And I think that the intellectual debate needs to continue to try to influence at least the mindset of policymakers, because otherwise they become subject to, or they can become subject to groupthink, the groupthink of the institution. And it's important, as one lesson of the crisis, that we continue sometimes to offer a bit of lateral thinking or different thinking. So this is one center. Another center is Oxford. There are a couple of scholars there with whom I work, which also have done a great deal of work in this idea of law and finance. And then the two entities or two institutions that are behind this book that I mentioned earlier, which are John Jackson and Georgetown in the US. Georgetown University is doing a very important part of intellectual activity in this area, and also drawing from the lessons of trade, what can finance learn. And then the WTI, which is the World Trade Institute in Bern in Switzerland, and again under the direction of Thomas Cotier, it is doing a lot of work. And then in Harvard, where I was a student, the work also of Hal Scott and Howell Jackson, it points also in the direction of continuing to develop the debate in this area. So there is a network of scholars around the world that is actually looking at these issues, and I have omitted some others. The list will become too long. I would say that the ones I have mentioned are centers of intellectual activity. And I think the challenge is to try to continue to work with policymakers and to kind of continue to have an intellectual exchange with those in international financial organizations, whether it's the BIS, the IMF, the European Central Bank, the European Commission, to have the set of tools ready, even if at the moment we cannot find the political will to actually put those set of tools into law, as when the time comes, when the time is ripe, we will have on the table the ideas and the plan that will help us to hopefully steer better through the next crisis than the way that we navigated through the current one. Because one thing is for sure, and that is that the too big to fail and the reliance on taxpayers' money has to stop, and that cannot be a resort in future. So we really need to develop systems, and those systems usually they have to be devised ex ante. I always like to put a comparison with extinguishing a fire. Of course, if there is a fire in a building, whether your building or my building, the first priority is to get rid of the fire, but then the second priority is to try to rewrite the rules, to rewrite the procedures to avoid, especially if the fire tends to be very damaging, to limit, first to prevent the fire from happening in the first place, but if the fire happens, how can we contain it more effectively? How can we limit the damage that any fire would definitely, almost by definition, cause to a building? And I think that that's where the intellectual efforts should move as we advance in the aftermath of the financial crisis, and perhaps by nature we become complacent. Well, things seems to be working well now, so why continue to work? I think there is no room for complacency. I think that we have, not just through the easing of monetary policies, but through a number of issues, we have perhaps been too long on sometimes institutions on life support mechanisms, and the understanding of risk is something that requires the dialogue, in this case, between law, economics, finance, in order to set the structures.
Rosa, thank you very much. It was a very, very
Thank you.
Comprehensive, very clear explanation, and I'm very grateful to you.